everyone. Welcome to Henry Wealth Management, our new office, our conference room. And I got my good friend, Greg Traskey from Symmetry Partners. He's a senior regional director. That just means we lean on him a lot because he's a really smart guy. And he's been in town for a couple of days. And Greg, I have to tell you, we have doubled the amount of attendees today. And the only thing that's changed is you.
Well, I appreciate it. I'm glad people came here to, I guess, see me.
So they're here. They like Greg. Now, Greg's met a lot of you at different events we've had, one-on-one meetings, webinars we've done before. So but we're glad you're. Thanks for being here. So we have a great presentation for you today. We're going to try to be in and out of this within 30 minutes. We will replay later on. There's a question box if you want to type to us and let us know what your questions are. We'll try to get to those on the program here. If not, certainly come back to you afterwards one-on-one. So this is the 2002 year in review perspective. We want to talk about what happened last year, what were the drivers of the underperformance relative to where we'd like to be, and what's going to happen as we go forward. We want to talk about that. So let's dive right in and talk about last year in perspective. Just slide this over here for a second. Here we go. So last year, stocks had their worst year since 2008. You can see on the screen here, U.S. stock market, the S&P 500 was down almost 20%. International, not quite so bad, 14 and change. Emerging stocks, 20. Global real estate took a big hit, minus 24. But bonds even took a hit. Bonds were down 13. So we'll talk about that. This is what happened last year. And here, let's get into these global markets in review. And we can see a little bit of a good sign in the fourth quarter, however. U.S. equities, look at this, I'll point to the air here. Look what happened, about a 6 to 7% rebound in the fourth quarter. Still a terrible year, minus, there's a minus 20% we talked about. International equities had a tremendous quarter, over 15%, and they outperformed U.S. last year. They outperformed by losing less, maybe 14%. And the emerging markets had a very strong fourth quarter as well, and about an equally bad year as U.S. Equities. So, Greg, we look at this, but then we look out here over 20 years and speak to this slide about why we're in this for the long run. What happens over 20 years, domestic, international, and even emerging markets?
Yeah, absolutely, Phil. Thanks for having me on today. It was certainly an interesting year in markets, and it was up and down all year, very volatile. Mostly down overall. And what triggered that volatility in the markets was a combination of the ongoing implications from the pandemic, the breakout of the land war in Ukraine, inflation hitting a multi-decade high, and unprecedented Fed rate hikes that they used to try and combat the inflation, right? And so these headlines, certainly a headline-filled year in markets, and it's these short-term impacts that are driving the volatility in markets. Now, we've always been a proponent of a longer-term investment philosophy, sticking with it through thick and thin, and ignoring the short-term noise as hard as that can be. So, you look out over the 20-year and you see that on average, U.S. equity markets are return about 10% annually, right? International developed markets have historically given slightly less than that. And 2 years ago, we were having conversations with clients about why would I even want international markets in my portfolio? We were going through a decade where U.S. markets were on a run. It was primarily driven by growth stocks and technology stocks, just a handful in the U.S. market. And the reason we believe in international markets is for their diversification benefits. Mm-hmm. And so while they might not always be the leading performer, right, what we're seeing here is that they tend to be performing during times of volatility when U.S. markets might not be doing so strongly.
Right. So last year, diversification helped. Still negative year, but the diversification helped. And certainly our clients weren't down 20% because we have very few clients that are 100% in stocks. We have all the other asset classes. And we'll dive into that more as we go through here. But let's look at this. This is huge. These are growth stocks. Many of you, we looked at your 401k plans over the past 3-4 years, and which are heavy in growth stocks. And you're saying, rightfully so, hey, my portfolio is outperforming Symmetry. because symmetry has more of a value tilt. We still have growth, but it's not predominantly growth. But look what happened to growth last year. The FANG bubble deflated. What's FANG? It's Facebook, it's Amazon, Apple, it's Netflix, and Google. There's the FANG. And these were down. Look right here. If you, I hope they can follow my arrow here. The Russell 3000 was down 19%, which is again close to the U.S. Market. But look at Apple, minus 26, Google minus 38, Amazon minus 49, Netflix minus 51, Facebook minus 64. So these were the drivers in 3 or 4 of the last 5 years. But last year they got swacked. And this is why we want to diversify and not be too heavy in any one area. Fair?
Absolutely.
And now, again, so we talk about value and growth stocks, and this is a slide that Greg will address that talks about the difference in pricing between growth stocks, those FANGs were the leaders, and value stocks, which Symmetry is a proponent of tilting towards value. Please explain what this slide looks and why value stocks still look relatively cheap.
Yeah, absolutely. This is kind of the "we told you so" slide, for lack of a better term, Phil. We watched these 5-6 stocks. You'll hear the term FANG or FAN Mag. It's just the addition of Microsoft into that mix. That was another driver of the S&P 500. Those 5 to 6 stocks made up over 20% of the S&P 500. And over the period of 2015 through the end of 2021, those stocks had annual or cumulative returns of between 300% and some of them over 1,000% over that 7-year period. Right. So those valuations went through the roof. And so what this slide is showing is how expensive growth stocks are. How much are you paying for growth stocks in comparison to value stocks? And what you can see is that earlier in the year, end of 2021, I mean, we were in the 99th percentile. The spreads between growth and value were the highest they've ever been historically. Higher than they were in the tech crash of 99, higher than they were in the financial crisis of 2008, Phil. And what you'll notice here is typically when the growth stocks are priced for perfection, they're priced at a premium like they have been, there's a reversion to the mean. And we saw that this year.
Reversion, yes.
We saw a spread. In fact, if you want to move to the next slide, Phil, this will be a little bit of an example of the point we're trying to make here, is that this year, U.S. growth stocks, which drove the market the prior decade, were down 33% collectively. Value stocks were only down about 6%. So the value stocks that held you back over the last decade were the buffer in your portfolio this year.
So the far left quadrant here is the value, and you see the orange line down 6. That's last year. Is this a what's the period? It's a 20-year period. 20-year period. They're almost up over 10. Small cap took a hit last year, but look how value was the leader among the losers, being only down 5. Small was down a lot more. Momentum was down. Quality was down, and minimum volatility. So the symmetry tilts towards certain factors, and the value and the minimum volatility tilts really worked last year. The only one that didn't work relative to market was the quality factor. That was down a little below market. But 4 of the 5 factors that symmetry tilts toward helped last year.
Correct, Phil. Symmetry and Henry Wealth Management have been long-term proponents of factor investing. The reality is that the factor tilts that we take into account in the portfolios, they don't work year in and year out. But more years than not, they have benefited your portfolio. And our objective is, for our clients, our investors, is to increase your probability of investing success. And what the academic research shows is that these factors, when used both individually and collectively, will give you a return premium above and beyond market, or a risk reduction.
Or combination, right.
And so this year was a great year for factor investors. As Phil mentioned, 4 out of the 5 factors outperformed the broader market. What was an interesting year is usually in a down market, quality is a buffer in the portfolio. And this year was a little different, where quality stocks did underperform. So that was a little bit of an enigma for us. But, again, right, when you sit through a long period of underperformance versus market, we believe in reversion to the mean, and we started to see that in the prior slide showed investors that we have a long way to go, especially with the value side. Your position portfolios are positioned really well to continue
Yes.
to outperform the broader market,
Right.
over the next, let's say, 5 to 10 years.
So let's keep advancing here.
Mhm.
Bonds. Now, what hurt last year was bonds had an historic, terrible year. Look at this chart right here, and you can see here that bonds, these are returns for 45 years, 46 years. And if you look here, basically around 95, bonds were down 3%. And around 99, they were down 1%. And around, here we are, 15, they were down 2%. In 21, down 2. But then all of a sudden in 22, down 13%. So equities are down 20%, bonds are down 13. We don't like that. Usually one balances off the other. This was a year that it didn't happen. Let's explain why this 13% aggregate bond return was down so far, and that we hopefully get past that. Does that continue into this year? But that was a big reason for the negativity last year. Let's talk as we get into here, and let's look at this next one here. There we go. So here's the fixed income factors. Would you please explain to our nice clients what happened to bonds and what are we going to do about it?
Yeah, absolutely. I mean, this year was a complete enigma in fixed income markets. It was one of the worst years we've ever had in history, and it was driven by primarily the largest detractor was the 10-year Treasury, which had its worst year in 234 years, which is almost the entire history of fixed income markets, Phil. And I wish we had more of an explanation for investors, but the reality is the same macroeconomic drivers that impacted equity markets were the same economic drivers that impacted fixed income markets, right? And so we had a really long period of extremely low interest rates for free money, basically, especially for corporations, and that came to a head in this year. And so what this slide shows is that interest rate risk, which is a factor that we believe in, asymmetry as a driver of additional return in fixed income markets, really was the driver of or detractor of returns in the fixed income markets this year. And so think of interest rate risk as put it simply, right? If you buy a bond and that bond is returning a 1% yield, and then you buy a bond that's got a 7% yield, you're taking on additional risk by purchasing that bond with the higher interest rate. And so when when the Fed raises interest rates goes up, that has an inverse reaction with the price of that bond. So your bond that you purchased with a 0.25% interest rate is now worth less on the secondary market than a brand new bond that might be yielding 4.25%, right? And so you had a long period across the spectrum between 30-day treasuries all the way up to 10-year and 30-year treasuries, where interest rates were low across the board, and so it impacted fixed income instruments in all different types of duration and maturities, and it was really detrimental to the fixed income markets overall. Now on credit risk, which is taking on additional risk due to think of high yield versus high quality, right? That was less impacted
very little
by the interest rates this year, and so that was a little bit of the buffer in the portfolios. But we have not seen a fixed income market environment like this in a very, very long time.
And if I could add, we also haven't seen in years and years and years low unemployment, but we had to raise rates to combat inflation. So those are the two combinations that really, so what we've seen now in last year, the inflation rate from a blog we wrote a couple months ago peaked at 9% in the summer. It was down to 7%. So we hate 7% inflation. We just don't hate it as much as 9%.
Absolutely.
And, so hopefully those factors mitigate each other, but we're not having to fight that battle again this year. The Fed has already said they hope to raise rates less than they said they were going to. So that's a good sign. We don't like the Fed raising rates, but we like when they raise them less than they thought they were going to.
Yeah.
So that, with inflation tampering down a little bit, those things have helped. So, and the bottom line then too is just to clean this up here. This is what we believe in. We believe in spreading the risk, having multiple asset classes, and take a look at this, if you will. And if you look at this purple box, this is what's happened over the last 10 years. Look at the purple box. 5 times it occupies the top row. And the purple box is U.S. real estate. Okay. So 5 very strong showings in 10 years. But look in 2020, real estate, the worst performer. In 2022, almost the worst performer. So when you look at this chart, you're going to go, well, why I should just buy commercial real estate? Well, get ready to get slammed 2 years. All right. Look at the next one. We'll look at one more. Green box represents U.S. growth stocks, those FANGs we talked about. Look at the green, a lot of green up near the top of the chart in all these years, but it started to slip in 21, and in 22, all the way down at the bottom. U.S. growth, the worst performer. So, and if I could run this chart back, this is a 10-year chart, 12-year chart. If we go back 10 more years, you would see growth down near the bottom of those charts and value. So then in the next 10 years, you have growth above value, and now you see it shifting back. Things shift. Nothing stays the same. That's why we want to diversify across all kinds of asset classes, not try to hone in on what we think is going to do the best. So I think that's important. So this really tells a story. And you know what? Look at the red box. It's the 60-40 blend of equities and fixed income. And that usually runs kind of down the middle of the page, which is what most of our investors want. Give me middle of the road returns without all the volatility. And it's certainly, not everyone's a 60-40 investor. Some people are going to be higher than that, a couple of people lower than that. But that's our average for our people in retirement mode in the 60-40, certainly pre-retirement, more aggressive than that. But I think that really, it tells a story. But let's shift gears now and get into, again, the top stories. You already mentioned the war in Ukraine. You mentioned COVID. But really the two we want to talk about are, this is Vance here, the two we want to talk about are, first of all, inflation. Gas prices. I'm not sure who paid 7.25. We didn't pay that in Pittsburgh, but we got over 5 for sure. Now we're down closer in the mid-3 range. What are you paying in Connecticut?
We're about $3 a gallon in Connecticut right now too.
Okay, we can duke it out here, right?
Yeah.
But certainly this is probably California, I would assume. But that was, inflation was the big, and the Fed trying to fight inflation. Explain to our clients what this CPI core services goods prices change means, Greg.
Yeah, absolutely. And so, take a little bit of a step back, Phil. We talked about some of the drivers in this year and the headlines, and it stemmed from the pandemic and a surplus of liquidity going into markets, stimulus, and right, and then combine that with the fact that because we were locked down and the supply chain issues that resulted from that, you had a higher demand for goods with a much lower supply. Mm-hmm. And so the immediate reaction of the Fed, their number one task coming out of the pandemic, was to get the labor market aligned with where it should be. We had unemployment rates at one point of 15 to 20%. And, historically, a good unemployment rate is, probably around like 4 to 4.5%. So their primary goal was getting the labor market back to where it needed to mm-hmm. be, right? And inflation was secondhand. And so when they're looking at inflation, they look at it from a number of different lenses. One of them being the cost of goods sold, a broader basket of goods sold. But they're keeping their eye on energy costs and food, which are current indicators of inflation. And the anticipation, I think, of the Federal Reserve was that as the supply chain corrects itself, and as things begin to normalize, and the inflation will take care of itself, right? And so as the unemployment rate lowered, we started to see that, food prices and energy prices were starting to curtail. They were starting to come back, right?
Those are core goods.
Correct.
Okay.
And so what we noticed, right, and what the Fed noticed is that the cost of services and other goods, beyond the cost of energy and food, which tend to be leading indicators of the economy, were still continuing to go up. And so they had to shift their focus, between Q1 and Q2 of this year to a really aggressive stance on inflation. So we saw the Fed take action at an unprecedented rate this year to try and curtail the rising costs of goods and services. And so, we saw the rates of 30-day T-bills rate increase almost 6,000% this year, Phil. And the overall Fed interest rate hikes go from 0 to 0.25% up to currently 4.25% and 4.5%. Right, so it was aggressive action that we haven't seen in decades, almost 50 years here, to try and battle the impact of inflation that was occurring as a result of both the end of the pandemic, if you want to call it that, a shift towards normalcy, as well as the impact of the war in Ukraine and the Western reaction to, put sanctions in place that would, hurt Russia by not purchasing their oil and their wheat. You have to keep in mind that Russia was the third largest producer of oil in the world, and Russia and Ukraine account for 30% of global wheat exports. So that was really what the drivers of inflation have been: the surplus of liquidity from the COVID pandemic, combined with the supply chain issues, and then exacerbated by the effects of the war in Ukraine and Western sanctions.
So fighting inflation was a key theme last year. If you look at core goods, this middle bullet point peaked in February, but has came down steadily since then. So those are all good signs. And the Fed, obviously, did they do enough? Too aggressive? Not enough? That's always a challenge. Curb your enthusiasm was, I guess, what the message was. That'd be a fun show, right?
That would be a good one.
But let's get into reality here. Fed fund rates versus unemployment rates. And let's speak to this slide, Greg.
Yeah, and we touched upon it a little bit when we were talking about inflation, Phil. The Fed's reaction was a historic reaction. We haven't seen a reaction like that in decades. By some metrics, it was the most exaggerated reaction that we've seen towards inflation in history. And what's an interesting and makes this economy and environment a little bit different is that you actually have a really robust economy right now and historically low unemployment, which is amazing considering our unemployment rate was 20% in 2020 when we shut down for the pandemic. And so, for investors who are paying close attention, you probably noticed that markets had a pretty strong recovery in Q4. And a lot of that recovery resulted within October and November, and then we saw a strong downturn again in December. And so what markets were accounting for was improving inflation data, improving economic data. And so that was what drove the increase in performance in recovery markets throughout October and November. Then, typically when good news occurs, right, that drives positive returns in markets. This year was a little different in the sense that good news in this situation was actually taken as bad news, right? Because the reality is that the economy was so robust and the labor market has improved so much that the Fed came back against what market anticipations were, that inflation was going to be continue to come down and we were going to start easing those interest rate hikes. And they said, we're going to continue to raise interest rates. We need to continue to curb inflation, even if that results in recession, increased unemployment. We're going to continue to make these drastic interest rate moves until we get inflation where it needs to be. And so markets reacted negatively in December. So far, year to date, we're seeing a very strong recovery with markets up, roughly year to date about 5%.
And again, some of the supply chain issues you talked about have been alleviated, and inflation seems to be coming back down. So we're hoping that continues in that regard. So a summary, what does this mean? What does it mean? What happened last year? And what do we think about going forward? Why don't you speak to this slide? Then I just have two more after this and we'll wrap this up. But give us a little summary about what this means for our investors.
Phil, ultimately, I wish I came bearing better news, but it means volatility is going to continue.
Okay.
And I don't want investors to get scared when I say volatility. Volatility is the price you pay. This was the line of my former colleague, Dana Dioria. Volatility is the price you pay to capture the returns that markets have to offer, right? And so the volatility that we're experiencing is a result of this updated news. We're waiting to see how the Fed rate interest hikes, whether they got it right, as you said earlier, have they gotten it wrong? Do we need to be more aggressive? Or can we slow down on those interest rates? And so we're in for more volatility. However, right, volatile markets can go up.
That's right.
And volatile markets can result in negative performance. Yeah. So I don't want investors to think because we're saying markets are going to continue to be volatile, that means that your portfolio is going to go down.
Yeah, right. Volatility goes both ways.
Correct.
And the key thing is this right here. Let's look at the case for optimism. Then one more slide. This is a 60-40 portfolio. Again, not everybody's in a 60-40, but just use this one as a proxy. You look at what happens after a 10% decline. We had that last year. What happens after a 10% decline in a 60-40 model? In the next 12 months, it's almost 8% return for the people that stay with it. See, the people that don't stay with it say, I'm scared, I'm going to get out, I'll get back in when things calm down. So they suffer the loss, the market goes up, then they get back in. So they lose by selling and they lose by not having a gain. They get back in up higher if they ever do get back in. So this says average over 100 years of data. A 10% decline, you can expect an 8% return the following year. You can expect 17.4% return over the 3-year period. That's cumulative in a 60-40, and 37% over a 5-year period if you just stay with the program. And I'm preaching to the choir. We don't have clients that are jumping around. We have a little saying here: you don't have to like your portfolio, you just have to live with it.
Yeah, Phil, I was sitting down with an advisor yesterday, and he says, I'm the tortoise. He goes, I'm the most boring investor you'll ever meet, but I come out ahead of everyone else.
Yeah, so you don't have to like it, but you live with it, and you live with it, and it works out. And let's just look at this, and we've shown this slide to a lot of people as we wrap up here. What happens over 100 years? $100 in the S&P turns into, this is the S&P, $100 turns into 1531. What's the time period here?
1926 through 2020.
I haven't seen this slide before. I'm looking at a different one. But anyways, tremendous growth. And this involves you staying in during Black Monday, October 19th, 87, when stocks fell 20% in one day. Now they recovered within 3 months, but that was a big one-day drop. 9/11, you stay invested. .com crash in 2000, you stay invested. COVID 2020, you stay invested. People forget that in 2020, the Dow Jones was down 25% in one quarter, and then you finish the year winning with a positive return after giving up 3 touchdowns in the first quarter. You win the game. So that's the story. So let's see if we have any questions here. Do we have questions? That assumes I know how to run this box. Okay. Someone asked a question: what is Symmetry's perspective on crypto? You're the expert. Tell me what Symmetry's opinion is on crypto.
Yeah. And so, I think there's kind of 2 parts to this question here. One is, what is our, the initial one is, what is our perspective on crypto, and then should you invest in it? And so, when I'm talking directly with clients, I say, at minimum, 80% of your investable assets should be in a long-term buy and hold strategy, exactly what you're doing, right? Anything beyond that, we refer to as speculation, right? It's speculative assets, active management. If you want to take some money and start buying stocks and
individual stocks,
right? Exactly. We view that as speculation, right? And what the data shows is that most investors, when you're doing things like that, end up, underperforming the broader market. So, I never recommend anybody go all in with any type of speculation, whether it be active management, cryptocurrency, alternative type of investing, derivatives, things like that. Specific to cryptocurrency, we're not a believer. we believe in investing, right? And so investing has to be a physical asset, some type of commodity, a business that's going to generate profitability and give you a return on that investment. Cryptocurrency is not a physical asset. There's no tangible product that you're actually owning, right?
It's all speculative.
And
It's
so,
price speculation.
yeah, we've done a lot of research on the topic, and what's interesting is the blockchain technology that runs on is actually really, really sophisticated, really great technology. If you were investing in that technology, that might be something that was, a very valuable investment for somebody. Cryptocurrency is just a byproduct of that technology, and so we believe it's a very, very speculative. It's a very risky asset to invest in, and it was certainly a bubble. I mean, we saw Bitcoin well over, I believe, $40,000 per coin, and now it's gone under sub 10 per coin this year. So it's certainly not for the faint of heart. I would never tell anybody if you want to, feel free to do what you want. I would go in with very, very small proportions of your assets, but it's not something that we have any intentions of incorporating into our portfolio.
So, yeah, it won't be part of our portfolios. If you want to do it on your own, that's with a small amount, but we don't. It's your money. You can do what you want. We don't want to bless it, and we're not going to put it into our portfolios.
Yeah.
So, hey, with that in mind, that concludes us. So we came in right here a little over 30, so right where we want to be. Thank you. We love our clients. We're grateful for you. If you have other questions, you know how to get a hold of us. We'd love to hear from you. We'll be in touch with you for periodic review meetings, as we always are. We thank you for your business and your trust. At Henry Wealth Management, we have a little tagline: the first thing we earn is trust, and we're grateful for yours. So thank you for joining us today, Greg. Thanks for coming to Pittsburgh.
Thanks for having me.
And you know what? We're going to have this guy. He's a smart guy here. We're going to have him again. So have a great day. Thank you. And this replay will be pushed out on a blog. If you want to catch some part of it later on, within a few days, we'll have a blog with this replay. Thank you. Have a wonderful day, and may your favorite team win this weekend. Take care.